Smart money, right? Smart money concepts, SMT, or which is smart money, or SMC, smart money concepts. Uh, I guess SMT is smart money trading, but what I found is that, right, you want to follow smart money because smart money is the institutions. The institutions operate within the parameters of the algorithm, right? And the algorithm operates outside the parameters that a retail trader has. So when we're thinking about this, we think, okay, these red wick rejections are long tape profits and short tape profits, right? So short tape profits would be a red wick rejection down to the bear side, and a long tape profit would be a red wick rejection to the bullish side, right? So, and those are smart money uh, tape profits, areas where smart money would be taking the profits. So we're thinking about, okay, if smart money is looking to take profits there on a scale of we want to follow smart money, but how do we know and where do we know that smart money is in the market? We know that smart money is in the market when we get manipulation, right? Because power 3 is accumulation, manipulation, distribution, or distribution, manipulation, accumulation, just as uh, quarterly theory is accumulation, consolidation, manipulation, and then distribution, which is pretty much the same thing as power 3, right? Quarterly theory and power 3 literally fit within each other because manipulation is pretty much consolidation, right? Because it's a consolidating and it's engineering liquidity, right? So that's pretty much what manipulation is, right? They're engineering liquidity. So these engineered points of liquidity, right, can only be uh, these engineered points of liquidity are green wick rejections, right? So a green wick rejection to the bullish side is short or short stop losses, right? You could say retail short stop losses, but they're just short stop losses, right? And then a wick rejection down to the bearish side with the green candle is long stop losses, right? Retail long stop losses, right? And the market, the algorithm wants to take them out of the market before then we continue to push, right? And smart money, right? These big firms trading on smart money concepts and trading pretty much just based off the algorithm know the algorithm best because they're trading off the algorithm. So with that being said, whenever we see a push into, like a tap into or a tap below a green wick rejection, and then we see a reaction, right? So let's say we're pushing bearish and it goes below a green wick rejection down to the bear side, right? That then is going to that's then going to stop out a bunch of long traders, right? And then if we see a reaction to the bull side break of structure, and then we see the pushing to the bull side, then we can look for an entry, right? Because it shows us that, okay, if traders just got stopped out, right? Their stop loss were just taken long, stop loss were just taken. Why would it be logical for price then to go up? It's only logical for price to go up if somebody is following the algorithm. So you find out within these manipulation cycles where smart money is participating in the market, right? Because smart money particularly only enters when they can manipulate slash or engineer liquidity, right? So they're engineering liquidity. And so primarily they're only going to be entering in on that range that occurs after the manipulation, if it indeed shows us a break of structure and significance, right? If it doesn't show us a break of structure, then we wouldn't look to enter on a retracement. So the same thing is done with shorts, right? Short entries. So if we have the pushing above a green wick rejection, right, a previous green wick rejection, and then we start to see the pushing down, or even a tap into a green wick rejection, and then we start to see the push down, a break of structure, the push down and it creates a break of structure, that's going to tell us, okay, shorts just got stopped out, right? So why would the market want to continue to push down the bear side? Wouldn't it want to push the market up, right? And this is where retail, right? Retail will get in long, right? Because they're like, oh, green wick rejection. If we have the push above that, right? So if we have to push up of that green wick rejection, it shows us short a short squeeze. But what they don't know is that no, it has to close above that, right? It has to close above that. So what smart money does is, or the algorithm does, is the algorithm pushes it up into it, maybe even above it, but doesn't close above it, right? And then we see a reaction down to the bear side because retail longs got into the market. Smart money started shorting because the retail longs facilitated the shorting capabilities because you have to borrow shares, right? So if there's no shares to borrow, you can't short the stock, right? But now retail just took on all those longs, which then are held by obviously like an institution. So like the New York Stock Exchange holds your shares pretty much. Like they have them on like the books, right? And then they're like, okay, we can have this many shorts, right? Uh, it's based on like the volume, right? And so they have a bunch of short positions. Retail just got in long. They're pushing the market down. Retail's trying to get out of the market and sell. So what happens? What happens is that smart money will take their short, take profits, right? They then will start to push the market up as they accumulate more short positions, right? Or distribution. This can be called distribution, right? Because shares are being distributed, right? And then they're taking on more short positions, right? But they're pushing the market up slowly, 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 not to get any more longs in the market because they don't want longs in the market because it's just going to create the same choppiness within the market. So what they do is they push it up to that point, right? And then just enough so that retail can enter out a uh, on a like on like a net zero, pretty much like a net zero uh, profit loss standard, right? Because retail doesn't want to lose, right? So what they will do is they'll overextend themselves, overhold, right? And then they'll be like, I'll just get out when it hits break even. And that's what they pretty much do, right? And they push the market up to that point, right? Retail then sells, a bunch of people then, or no, because when retail sells, then the market starts to go down, right? Then more people start shorting, and then the market pretty much just goes down, and that would be a balanced market. So we're in the efforts of seeing that manipulation occur, right? The breaking above a green wick rejection to the bull side, having the push above it, and then having a reaction down to the bear side break of structure, and then we see that that trend caused significance, which would tell us, okay, smart money's within this trend structure. We then know, okay, they're going to be looking to take more shorts, right? So there's going to be more short illiquid market orders, and then they're gonna push the market down off of that. Now, what you also have to do is you have to understand that, okay, we can take counter trend moves, but we also have to understand the other side of the market, right? So now we're able to take counter trend moves, but particularly you want to stick to trending moves, right? So you want to be like, if you're looking and you see whatever, like, a it's pushing down, right? So you're in a bearish trend making lower lows and lower highs, or lower highs and lower lows. No, lower lows and lower highs, right? Because lower low occurs first, particularly. And then you see that you get a push below a green wick rejection, and then you have a small move up, right? And when you have that small move up, you could enter counter trend, but it's pushing up to high probability that's pushing back up to grab sell side liquidity or red primer, right? Because it applied too much red primer. Remember that paint analogy, painting the wall analogy, right? So, and if you don't remember that, then just go to my Instagram and all my reels. If you go to my profile and then go to all my reels, you can see all the notes that I've been taking on a whiteboard. There's like over 100 now. But yeah, and then so they're pushing up for to grab those liquid orders, right? So you want to take note of that. You want to have an objective in mind, right? Whereas if, let's say, they push the markets down, and then you're like, there's no other reason for it to go down even more, then you could be looking to take a bigger long, right? And a long that's going to last a lot longer. And because okay, where does a Judas swing, right? So a Judas swing, right? So it's a swing and the pricing of the chart. And a Judas swing is when it enters somebody into the market, right? In the belief that the market's going to push that way, right? But it doesn't, right? So, like a red wick rejection down to the bearish side, the breaking below that, or the breaking even into that, if it's like a very strong candle, the breaking into it, then you'd be like, okay, this shows us that retail shorts are getting into the market prematurely because they believe that they placed a liquid orders look over there because they have FOMO. They have FOMO, so they're not going to wait for confirmation. Then the market's then going to continue to push below that low, and they're just going to enter a look over there. Right. So what happens is the market will then push up. Right. They'll then take all those shorts. Right. And retail will buy back. Right. So now retail is holding the bought orders back, and then smart money will just push it up into and all while right because all while retailers are continuing to buy, right? So a Judas swing, high probability that pushing up that you see after the pushing below a red wick rejection down to the bear side, that pushing up should be very quick. And if it's not very quick, then it would show that you might have consolidation coming to the market. And when it's very quick, lots of retails are going to be getting in long into the market. They're pushing the market back up to grab sell side liquidity or grab that red primer where smart money is getting in short into the market, and then the price just dumps, and retail's holding all the long orders that facilitated the short orders of smart money, and they just push the market down, right? So that's the Judas swing. Same to the bull side, right? If you have the pushing above a red, no, if you have right, because if you have the pushing above a red wick rejection to the bullish side, that's going to be buyer take profits, right? So it's the pushing above a green wick rejection to the bullish side would be a Judas swing, or the pushing even into it would be a Judas swing within proper context, right? Because obviously, like, it could just be a smart money's getting a short and they wanted to then push the market down to the bear side, right? So with that being said, I'll show some examples. I haven't even found any. Let me find some. Or I found one. Let's see. Okay, yes. And also, if these green wick rejections down to the bearish side, right, because those are the manipulation. If those actually cause like significance in price, there's going to be a lot of there's going to be a lot of long orders. Look at it right there, right? So there's a high probability that you then get to push to the bull side, right? So if you're looking at this right here, and you're seeing over here, right, you have a wick rejection down to the bear side, price then broke that. We then see a reaction of the bull side breaking above this high, look at it right here, which caused significance in pushing down to the bear side, or even this, look at it right here. You then take your Fibonacci level from the low all the way to the high. And like sometimes it doesn't hit, like it doesn't come back down to a discount, right? So you have to just use your common sense. Oh, look at it right here. This green wick reduction to the bull side, which is high probability of being what? It's high probability of being those retail long orders, a liquid long orders, right? Because they haven't been filled, so they're not liquidated, right? And the market then pushes back to the bull side, right? It pushes up $18 for Ethereum, which is like a pretty large amount, right? And you're like, okay, why is it pushing then up, right? So we have this green wick projection, look at it right there, right? The overall market overall market bias is pushing down to the bear side, right? So we're taking a counter trend, right? We're then like, okay, if they want to continue to push the market down to the bear side, if they push it into a green wick projection, they're going to manipulate before then they distribute, right? So with that being said, manipulation is going to happen before they distribute. And then it's just going to continue to push all the way down to the bear side. So you have to think, okay, how is you really have to go deep in your mind, and you have to really bring these things out of being like, how does the market operate? Do how does smart money manipulate, right? So power 3, accumulation, manipulation, distribution, or distribution, manipulation, accumulation, right? So, that manipulation occurs because it's liquidity being engineered, right? Liquidity being engineered. And then same with if a higher high causes a lower low, that higher high has to cause a lower low quickly. That higher high causing a lower low would also be a manipulation, right? Because a higher high, we wouldn't believe that it would cause a lower low, right? Because a higher high is grabbing sell side liquidity and then coming back down, right? And then you would think, okay, it's going to grab buy side liquidity and go back to the bull side. So there's like a bunch of people that are going to be buying, look at it right there, right? And then the market then just continues to push down to the bear side, and you're like, what? And yeah, there's then a bunch of people that entered long when the higher high was created on the retracement that want to get in long. The market just continues to push down to the bear side. You have to think, why is the market continue to push down to the bear side? It's probably just because buying and selling pressure. That doesn't make any sense. Why would it just be because buying and selling pressure? It just pushed below that point of liquidity. That doesn't make any sense. Oh, rather it's just it's smart money. It's smart money. Smart money, president of the market. So I mean, you really, the deeper you go into your brain and how it operates is the deeper you're going to go into the markets and how they operate. We're always looking for conviction in the markets, and we're also looking for confirmation, right? Confirmation is a big one. Because you're just okay, if we get the higher high, right? And then okay, this higher high pushed where? Right? So let's say it pushed into a green wick rejection, right? You're like, manipulation is going to occur. It's engineering liquidity. Creates that lower low. Then you're like, I can enter off a retracement because a higher high causes a lower low, meaning that there's manipulation occurring in the market. Same as, you see the pushing into a green wick rejection down to the bear side, and then you see a break of structure of the bull side. You're like, smart money's in efforts right there. Another big thing is because like biased only goes so far, right? Market bias only goes so far. Understanding different time frames and how those time frames are pushing only goes so far because you have to also understand where is liquidity located, where's the market then pushing back to. Um, because if you don't understand that, then you really can't understand much else, right? What has to occur before then this can occur, right? What is likely to occur before then this occurs? Market is pretty much just common sense. Common sense. Because if you look at Ethereum, you know that, okay, you have a bunch of red wick rejection up to the bull side, right? Which is what? It's going to be uh, smart money. Or you can say smart money, but primarily it is smart money, right? But it's their take profits. So their take profits, and then above that, you have a green wick projections. You're like, smart money take profits. Look at it right there. Then you have a green wick projection. Look at it right there. So you're like, they're taking profits, pushing it into a green wick projection, and then pushing down to the bear side. Engineering liquidity. Engineering liquidity. But yeah, pretty much just knowing what has to occur in the market before then this can occur, right? Because you don't want to just be like, it's making higher highs and higher lows. Let's look for an entry right here because this caused significant. That does not make any sense because you're not having any confirmation of that. The only confirmation is that a higher high is created. Higher highs are always created. It's either a higher high or a higher or a lower high. HH or a LH. And there is no confirmation of a higher high being created, right? Because you don't have the full retrospective picture of the market. You always have to have that. See, even like, look at it right here. You see a bunch of green wick projection down to the bear side. Look at it right there, right? It pushes into them. Look at it right here, right? But no higher high then is created, right? So like, oh, well, you got the breaking above this candle. Look at it right here. This green candle. Look at it right here. Did that green candle cause any significance? Hell no. There wasn't any significance created down to the bear side with that green candle. Oh, well, then you have a breaking below this. Look at over here, right? With that, you're like, the market wants to push down to this area. Look at over here. I probably push down to this area before we see even a retracement. And you're like, why would I be looking to go long right here? It doesn't make any sense. So, yeah. I post probably like 5 to 15 reels on Instagram a day. I try to do a lot. So yeah, go follow me at Deegan_Furland, all lower cases, on Instagram. But other than that, just keep grinding. Just go so fucking deep that nobody's ever gone because thinking is hard, right? But thinking gets easier, right? You become more creative with your thinking as you think more and more. It's kind of like you get more motivated as a project comes into fruition, right? You get more motivated when you see somebody else doing it, right? So if you plant an apple tree, you're not motivated to plant other apple trees because you haven't prospered the fruits of that apple tree. But when you start prospering the fruits of the apple tree, you're like, damn, this is good. This tastes good. Let me plant more because you know what's going to occur if you plant more. You get more apples. So, yeah, just keep planting those trees in your head and just keep going further and further and further and further. Because if you think deeper than somebody else in the markets, you're going to go way further because you're trading against somebody else. The algorithm was created off of average people. If you think more than the average person, you're going to go further than them. It just makes sense. If you think 50%, if you're in the top 50% of traders, or would that be the bottom 50%? If you're like closer to 1, then thinking more than those 50% traders, you're gonna win. Like you see all these traders like just like, yeah, go on the charts and look for a trade for 2 to 3 hours a day. Sometimes it's only 30 minutes. And then I'm off the charts and I could just do what I want to do. It's like, you're not going to get any better by doing that. Like, how are you going to get any better? Like, traders, you have to. It just doesn't make any sense. Like, I'm sorry. Like, same with like traders where like they aren't like challenging themselves. Like, you see, like, there's one guy and he's just been making like 6, 7K, a couple times a week for the last freaking like 3 years. It's like, bro, you gotta step up. Or last like 2 years. It's like, you gotta step up. Like, that's like Q Banks is like, I like his trading style because he always challenges himself. Like, he's a motherfucker that makes freaking sometimes, but also sometimes he's just like gambling, like, because like he's not on the charts all the time. A hell of a lot more than everybody else. But yeah, trading is just an evolution game. Um, but yeah, just keep on the charts. The more time you're on the charts, right? You can't lose if you're on the charts for freaking, even like 5 hours a day. If you're on the charts for 5 hours a day and you're just looking at charts, there's no way you can lose because 50% of other people are losers, or whatever, 95%. So you have to be the 5%, right? So okay, you just have to be the 5%. So that may be like 10 hours a day on the charts. But maybe you think differently. Maybe you think differently, so you don't have to be on the charts that long. Maybe you have really focused work, right? You don't have to be on the charts that long, right? So maybe you can be on the charts for 3, 4 hours a day, just looking at shit, not trading, right? But just looking at stuff. So maybe you do your trading and then you're on the charts, back testing, forward testing, just looking at everything. But yeah, if you want more, just go to my Instagram, Deegan_Farland, all lower cases. And yeah, just keep grinding harder than all of them. It'll show. It'll show. There's an endless amount of money that can be made in trading. Millions of dollars a day just trading off a personal account. Like, yeah.